Good morning, everyone. Good morning to those of you on the West Coast, I should say, and those of you joining us from the East, good afternoon. On behalf of the Real Estate Roundtable Board of Directors, our Chair, Deb Cafaro, our Chair-elect, John Fish, I want to welcome everyone and thank you for joining us today. We've got a great conversation coming up with, as Michelle mentioned, our guest today, the president of the Dallas Fed, Robert Kaplan. Joining us is going to be the Roundtable's former chairman emeritus, Robert Bobby Taubman, who is the CEO of the Taubman Companies, and we all know Bobby. And Bobby and I are going to grill. We're going to totally grill Mr. Kaplan when we get our chance. But I do want to welcome everyone. I want to thank you for your support. I want to let you know that this is the first of a number of videos that we'll be doing this month that you'll be seeing. For example, we have a video coming up with Brian Deese, who's the director of the National Council of Economic Council at the President's office. We have the Secretary of Commerce, Gina Raimondo. We have a number of senators and pollsters. So we have a big month and a lot of things going on in Washington. So today we're going to talk Fed policy, monetary policy, inflation, and whatever else we can talk about. You have his bio, Mr. Kaplan's extensive bio, so I won't go through that except to say that he is the 13th president and CEO of the Federal Reserve Bank of Dallas. He's had that position since 2015. He is representing on the Open Market Committee for the Fed. He previously was the Marshall Professor of Management Practice and Senior Associate Dean at Harvard Business School. Prior to joining Harvard in 2006, Mr. Kaplan was vice chairman at Goldman Sachs and had global responsibility for the firm's investment banking and investment management divisions. I think we'll stop there because we want to get to the questions and get to the conversation. Please submit your questions if you'd like to, as Michelle said, and we'll move along. Mr. Kaplan, thank you for joining us, and please give us some opening thoughts, and then we'll get into some details. Thank you, sir.
All right, Jeff, Bobby, everybody, it's good to be here. Yeah, and I'm going to very briefly just set the table, just in 5, 6, 7 minutes, and let me get right into it. It's the forecast of the Dallas Fed. Our base case forecast for 2021 is that the U.S. economy will grow by approximately 6.5% a year. Now, some of you may say, gee, I've heard much more aggressive forecasts from others. And I know you have. And I take note of that. So whatever it ultimately turns out to be, we're going to have aggressive growth in 2021. And we think the unemployment rate will trend down toward 4% by the end of the year. The big driver and the reason for this improvement is obviously vaccines outpacing spread of the virus. I'd say on that front, we're not out of the woods yet. And for some of you in certain parts of the country, you're experiencing what I'm talking about. But we are hopeful that as we get through the next several months, the vaccines will outpace spread of the virus. And we'll see increased mobility and engagement. And that's across the board. Credit card spending, trips, people being willing to engage in a whole range of activities that they've been reluctant to engage in over the last year. And that's going to drive particularly reopening of the person-to-person service sector, which I know many of you are in, or are landlords to, but it's going to drive those sectors. And the other element that's driving this forecast is substantial fiscal policy, much more substantial as a percentage of GDP than we had during the Great Recession. And so that's the outlook, and I'm sure we're going to go much more deep into that and implications for monetary policy. Let me make 2 or 3 other comments, though, just to set the table. There are 2 or 3 things about this pandemic that are worth noting that are meaningfully different than the Great Recession. Number 1, during the Great Recession and during most normal recessions, when you have a severe contraction in GDP, you also get a substantial decline in household income and in consumer spending. That did not happen this time. Household spending during 2020 stayed relatively solid. Consumer spending was strong. The mix changed, no doubt, but the consumer spending was strong. Why is that? Fiscal policy. Fiscal support was substantial. It was immediate, and it allowed people that had lost their jobs or couldn't get enough hours to still spend and make ends meet. So that's very unusual, and that's why the GDP decline last year was substantially better than it would have been and substantially better than many other countries in the world. Second comment, the pandemic, we know, and you know, the pandemic disproportionately affected different kind of industries, particularly person-to-person service industries. Many businesses, depending on the industry, had record years last year and did very well. Goods producing industries did very well, and service sector industries did well if you could use technology to still deal with your customers. What maybe hasn't been talked about as much is the way it's affected the workforce differently. If you had a college education, it is far less likely you lost your job last year. It is much more likely you could do your job successfully by working remotely. On the other hand, if you're one of the 46 million people in this country that has a high school education or less, it is far less likely that you could work remotely. You're probably in a job where maybe a person-to-person contact service sector job where you had to show up in person to do your job, and you're much more likely to have lost your job, and you're much more likely, if you didn't lose your job, to lose substantial hours. And fiscal policy and unemployment benefits is how you're able to make ends meet. One of the challenges, and the reason I mention this, is one of the challenges coming out of this pandemic is to get those people back into the workforce, maybe not in their old job, maybe not even in their old industry. And for some of them, they may have to initially take a part-time job, go for skill training, and get retrained in order to get satisfactory and higher paying permanent work. So that's one structural issue. Second comment, and I'll stop here in the interest of time. This pandemic has affected women with children very differently than the Great Recession. Women with children, working women with children, have disproportionately left the workforce during this pandemic. The prime age, i.e. 25 to 50-year-old working woman in this country has seen that as a group, they've seen their participation decline in the labor force by over 5 percentage points. That is a substantial decline. Why? For the reasons you could guess. They had to be home with school-age children because kids couldn't go to school in person, and lack of access to childcare and affordable childcare for many. And so again, one of the challenges coming out of this pandemic, if we're going to grow faster in the years ahead, is to find ways, open schools in person, certainly by the fall, better access to childcare, and a number of actions that would help working women get back into the workforce, because what we don't want is that percentage participation to decline permanently or on a long-term basis, because it just means smaller workforce, less GDP growth, less economic growth. We can talk about a number of other trends. The most notable, obviously, is the explosion. There was technology-enabled disruption was a significant trend pre-pandemic. This has accelerated that trend. And for example, as it relates to the real estate industry, I know we've been talking, and many of you have been telling me for years, we're overstored in the United States per capita. It's going to reduce. This pandemic has likely accelerated that trend. And we're seeing that across a range of industries. It's part of the reason why we have a semiconductor shortage, substantial increase in data usage. And so we're working to understand those trends. And so, but let me stop there. That's a thumbnail, and let me turn it back to Jeff, and we'll go into questions.
Thank you for those opening comments. And Bobby probably has a few things to ask here. I would just mention that within our industry, obviously the pandemic had varying impacts as well. Certainly lodging and retail hit harder than, for example, industrial or office, and multifamily has held up reasonably well. And maybe we can talk a little bit about why that is.
That whole ecosystem.
That'd be great. Bobby, would you like to add anything?
Well, sure. I mean, we can go down that road to start. There are a whole bunch of questions that come from your opening comments, Rob. And again, I want to thank you on behalf of the roundtable for joining us today. But clearly, as Jeff said, and you suggested, retail has been more impacted, and it's obviously a long-term trend that has accelerated really at warp speed. But things like industrial have been unbelievably positive. But this whole issue of the structural unemployment, participation rate, women that you talked about, it does sound like there is sort of a mismatch of workers' skills to, I'll say, the skills required to fill vacancies and the desire of people to go out there and actually work at a minimum wage or higher. Is that something that the Fed is focused on, this mismatch of skills, the retraining of people?
Yes. So, and again, this is particularly the case, that's why I mentioned it, for folks with a high school education or lower levels of educational attainment, because yes, there is a mismatch. And the issue about the workforce is worker mobility is historically low, but that's been true for years. What I mean by that, you're going to move, if you've got a high school education or less, you're not that likely to move 1,000 miles to take a new job. So if you've lost your job in a restaurant or a store, and you want to get you want to get back into the workforce, your first order of business is going to be find something in your locally. And so this puts a big onus. I spend a lot of time talking to junior college superintendents and even high school superintendents about skills training. And I would tell you, it's very uneven in the United States. There are certain centers of excellence where the junior college president and even the high school superintendent is out interviewing businesses in their local community, figuring out where the job openings are and backward integrating into a curriculum, which often the businesses will pay for, and using many businesses to teach the class. That's the new age high school and junior college, but it's not being adopted everywhere. But that's necessary because, again, workers will find jobs. I'm convinced, but what I'm hearing and seeing is without reskilling for some of them, they'll find something that's kind of suboptimal, maybe part-time. You made the point, if it's less than $12 to $15 an hour, they're already getting unemployment benefits, and they may be more reluctant and much more selective. That will phase out by September. But there's a big mismatch challenge to get workers back into the workforce, and it's in our interest to get them back, number one, in the workforce. But to the extent they go for skills training, they're going to be more productive. It's higher GDP, and we've heard from junior college presidents, you should know, enrollment among low-income workers, particularly Blacks and Hispanics, has dropped precipitously since the start of the pandemic. Two major reasons: loss of a part-time job, lack of access to Wi-Fi. So if you're looking at the puzzle in getting this mismatch addressed, one is part-time work coming back, but number two, Wi-Fi. We need better Wi-Fi access, and we need to fill in some of these blind spots, because the more Wi-Fi access, also that will facilitate getting people back into the workforce.
So that was very thoughtful. Thank you. As you, in your comments, you did not talk about inflation.
Because I promised to talk in 7 minutes.
Well, I think it is something, certainly bond traders have been, very focused on inflation and worried about inflation. I don't know if the Fed fears inflation at this point. Chairman Powell, I think, noted yesterday that inflation may be temporary, but they're going to watch it closely. What can you comment on in the context of your focus? Because obviously, it's price stability is part of the dual mandate of the Fed.
So I spend a substantial amount, and I assume that we'd handle that in the Q&A, and here's my views. We're already seeing a price surge now, an adjustment. Semiconductors, building products, wood products, packaging products, food items. I can go on and on across the board. And this is why you're starting to see a number of companies have announced, including consumer goods companies, that they're starting to put through price increases. And I talk to each of these industries, and here's what I'm learning. Part of this price surge year over, and by the way, this you'll notice this as we get into the summer, because year over year, you'll see that year over year price increases are going to be well in excess. I believe it well in excess of 2.5%, and it may be 3%, because the comparisons are so weak versus the same months last year. What I'm being told across industries, some of those supply demand imbalances will be fixed with new capacity coming on, which is underway. Some of them are due to hoarding. And so by and large, a lot of them will get resolved, what I'm being told by industry participants, in the next year. Some of them are going to take longer. Semiconductors is one that's going to take 18 to 24 months. But at the same time, you're dealing with these supply demand issues. You've got a surge in demand that's coming, certainly in the service sector, and you're going to have a tighter labor force, which means there's going to be more wage pressure. So I would say what I know is you're going to have this surge in 2021. What I don't know is how persistent it's going to be. Number of businesses I talk to tell me we're going to try to put in a price adjustment this year, but we're very skeptical that that's going to lead to year over year price increases. And others tell me they're a lot less sure about that. So I'd say the jury's out. So my job is going to be to track this very carefully and be very vigilant as we go through this year. And particularly the fourth quarter comparisons year over year are going to be very telling. Does it settle down into the fourth quarter, this surge, because last year fourth quarter was stronger? Or do we see more persistence? And that's where we're going to have to be, and my job, we're going to have to be on our toes to be monitoring this at the Fed.
So do you feel that the Fed still has the tools to be able to zigzag whichever way you need to go in this context that you've just described?
We have the tools. Here's the challenge. And I've said this before, we have a new framework on the one hand that says we're going to be less preemptive than we've been in the past in anticipating inflation. That's on the one hand. On the other hand, what I've said publicly several times, you don't want to go to the other extreme where, yes, you might be somewhat less preemptive, but you also don't want to go to the other extreme of being reactive and late. There's a balance there, and it's a risk management balance. And I'll say I'm trying to find that balance. So I'm still, whereas I'm going to look at outcomes, and that's been reported. Many of us have said we want to look at outcomes. That doesn't mean I'm also not going to look at forecasts. I am. And I talk to a range of businesses to talk about not only what's going on now, but what they're seeing. And I want to keep that balance. And so with the proper balance, I believe we have the tools. What you want to be careful about is using those tools late, because history has shown when we use those tools late, it sometimes has the potential to cause a severe slowing in the economy if you're too late.
So Jeff, just let me get one more question off this one, and then you'll jump in. The infrastructure bill that's out there, in the context of the tools and the balance that you're just talking about, I've sort of questioned, how do you find that balance with another $2 trillion of quote infrastructure?
So we'll have to see, first of all, what's actually passed, and as opposed to what's being discussed. But there's no question that if a substantial amount is passed, you'll see even a tighter labor force, means more demand for labor, okay? And a tighter labor force faster, even than what we're forecasting. On On the positive side, depending on what the investments are, I mentioned Wi-Fi as an example. Hopefully that's going to improve productivity, not just over the next few years, but over the next 20 or 30 years. But yeah, anytime there's fiscal actions or other changes, you got to keep recalibrating that balance. And there's no textbook for this because we haven't been through a period where we were shut down. We're now reopening. And then as a percentage of GDP, there's no great precedent in recent years of a fiscal policy that's this size of GDP. So I'm very aware of that. And I think the best thing I can do is just acknowledge it and be clear. We're going to have to be on our toes.
Well, there's no precedent for the deficits either.
Right.
So
that's right. And so
Jeff,
we've got our challenge, and I think we're better off just acknowledging that challenge.
Let me pick up on a couple of things. First of all, Bobby mentioned flexibility, and you said you felt the Fed still retains significant flexibility in what you're doing. And I'm just curious. Well, first of all, thank you to the Fed. I think what the Fed did a year ago, roughly, and acted quickly, and whether it was through the facilities that were set up or other liquidity attributes that the Fed undertook were great for the economy. And I think everyone should be extremely appreciative, or the economy would be very much in a worse situation. One thing, and you talk about inflation, over the last 10 years, I suppose, our industry has seen inflation in the terms of cost of production, steel, concrete, labor, and so forth. And we've also seen, I think, what you might call, or economists might call, asset inflation, where assets have inflated, but consumer prices have stayed relatively flat, which there are some people that suggest that has enabled, people who own assets to then make greater investments in their own education or their family's education or their own healthcare and stuff, causing that part of our economy to have price inflation on those things. And I just throw that out to you as we go forward in the next few years. There is now concern about consumer cost inflation, I guess, but asset inflation will continue. And if you could maybe comment a little on that.
Let me comment. So we track, a very large number of factors in the personal consumption expenditures. We look at CPI here at the Dallas Fed, and then we have our own measure of the inflation called the Dallas Trim Mean, which X's out extreme moves on both sides. And here's what I would tell you. And here's what we've been seeing up until the pandemic. Yeah, of course, on individual items, and you mentioned a few of them, we're seeing moves up in prices. Well, here's what we're also seeing. We're seeing technology and technology-enabled disruption limiting the pricing power of business. So that doesn't mean your costs aren't going up. Your costs are going up. For it to translate into inflation, you need to be able to pass it on to a customer. And technology and technology-enabled disruption is limiting that ability, okay? And so retail's a great example of that, where, physical versus online. And I will tell you that trend of technology and technology-enabled disruption is not slowing down. If anything, it's accelerating, because consumers are far more adept now at using technology to buy goods and services. And those of us who were slow haven't had a choice but to get faster because we didn't have a choice. Here's what I'm hearing from lots of different businesses. They're telling me consumer price sensitivity, they assure me, is not gone away at all. And the willingness to switch brand names to private label, online versus that's not gone away. So again, that's a factor. While you've got these individual cost increases and wage pressure, by the way, we've had wage pressure. How much of that will lead to margin erosion? How much of it instead will lead to actual end consumer prices? And that's, I think it's very unclear how those forces are going to play out.
That takes me right into something else I wanted, and you mentioned earlier, but trends that And we've seen a lot of trends within and retail, obviously, e-commerce versus brick and mortar, the trends, we know what direction that was going in. We've seen other trends now in terms of the use of technology, workers at home and so forth. And what, as you guys look, as the Fed looks at these trends, are there trends that you look at that you think are trends that are not going to continue?
Yeah.
Are there trends that you think that will continue but be mitigated a little? And are there things that you just think that's our new life and you need to, we all need to understand that?
So the best way I can talk about this is very quickly, segment by segment. So we know people haven't been staying in hotels. We know they haven't been going as much to retail stores. We think there's a big pent up desire to get out of the house and go out and experience things. They're not going to movie theaters. So there's a big pent up, and we're already seeing it in hotel bookings. Okay. That's already, if you talk to hotel chains around the country, they're seeing a pickup in forward bookings. That's connected with more flying, more forward reservations there. So clearly you're going to see real changes here. Having said that, a lot more people have gotten more comfortable, and I include myself in that, buying things online where I wanted to do more things physically. You know, dinosaurs like me are probably, there's some things which won't go back. On the workforce and on office buildings, and I think you alluded to it, most businesses, they worry about their culture, they worry about having people together physically, and so they want to get people back. But I'm also seeing, and again, depends very much by industry. I'll talk about, I won't mention any names, but law firms, law firm associates there's a huge demand right now and shortage of law firm associates. Okay, a lot of law firm associates are getting much more emboldened to say, I want to work remotely indefinitely. I don't want to come back to the office. They're being asked to come back in the office. They're politely or not so politely saying no. And oh, if by the way you make me, I will switch jobs and I got 5 bids. Okay, so the office dynamic, we're going to have to see how that unfolds. But all things being equal, there'll be a desire to get people back to the office. We're just going to have to see how this will work, remote versus in-person balance goes. And I don't think we know yet. And so I could go through other segments, but a lot of this, so you'll see trends, some will swing back, some won't. And the truth is, we're going to have to learn how this shakes out.
Well, it is interesting that nothing that you just won. It is interesting. You don't seem to be saying that there's a shortage of capital out there, and yet,
not
as
a
Bobby
shortage of
said,
capital
there's
at all.
another $2 trillion coming. The world central banks have flooded the markets and so forth.
There's not a shortage of capital for private business. And I will tell you, I don't think there's a shortage of capital globally to buy the US Treasury either.
Well, supposedly there's been $12 trillion of global central bank investment, I'll say, out there in total. So, I mean, there's a wash of capital. There's no question.
And that's not there are other trends too. There's an aging population around the world, very substantial pension fund assets. And when you look globally, US has been stronger as an economy and our rates are higher. And so there's a market clearing level, I certainly believe, for Treasury bonds. It may be, I think as we recover, I wouldn't surprise me for it to drift higher, the 10-year. It was 1 3/4 to 2% pre-pandemic. It certainly wouldn't surprise me to see it drift certainly beyond up to those levels. But I'm also hearing across the board globally and from market participants, there's a desire and a need to own duration given the aging of the population, in addition to what you've seen from central banks.
So we haven't talked about housing yet. You know, obviously the housing market is really strong and low rates, I think, are fueling some of that. And, you know, in almost all the desirable markets, you can't buy a house. I mean, there's just the multiple bids on a house. and there is a surge in prices. Do you think that we're setting ourselves up for another problem like we had a decade ago?
So
or do you feel comfortable?
So here's the difference. The Great Recession, the problem wasn't in and of itself higher home prices. The problem was the speculation, securitizations upon securitizations of securitizations, and 90 trillion of credit default swaps, a bulk of it related to housing. So I think that needs to be watched and monitored very carefully. There's no question by our reckoning, home prices are at historically, as you said, elevated levels. Part of it's mortgage rates, but part of it is structural. Harder to get permits locally, harder to assemble land banks. Out of the Great Recession, many builders are much more disciplined about keeping land banks that they don't intend to build on within a period of time. And it's an issue, and it's a structural issue as much as anything else. What it doesn't alarm me by itself, because I don't see the speculation related to it and the leveraging in the financial system related to it. But that's something we should keep a close eye on.
So we mentioned housing, so let's turn to commercial real estate. Are you concerned with the sort of exposure at the commercial banks around the country?
It strikes me that I hate to use this analogy, but I'll put in quotes, that bomb went off last year. What do I mean by that? Banks assessed their commercial real estate exposure, heavily reserved against that exposure. So that's not to say there isn't going to be a big adjustment period, and I think there may be in commercial real estate. I'm hopeful, based on what I know, that a substantial amount of it has been reserved for. So it's not that there won't be an issue, but I think it's heavily reflected on bank balance sheets already based on everything that I'm seeing.
I hope you're having fun. We're having fun, Rob.
Definitely.
Here's one that you probably can't answer, won't answer, but maybe, who knows?
Then this could be fun.
But how do you feel about some of the tax policies that are being discussed in terms of corporate? Forget about real estate or anything, but the corporate tax increases and the assertions that are made by some that this places U.S. corporations, particularly international players, at a disadvantage globally. How do you feel about that, or can you comment at all?
Yeah, I can comment on certain aspects. I'll deliberately avoid giving my views on some aspects of this because it's not appropriate as a central banker, and this is fiscal policy. Having said that, I'll mention two things that I'm very cognizant of. Number one, we know, as has been mentioned earlier, U.S. debt to GDP is at historically high levels, and what's more concerning to me is the path. I said this pre-pandemic, I think the path is likely unsustainable, and we're relying very heavily on the U.S. dollar remaining the world's reserve currency. And I think it's dangerous to rely too heavily on that presumption indefinitely. And so it doesn't surprise me that we're going to find ways and talk about ways to improve workforce growth, improve productivity, because we need to grow faster, and ways to moderate debt growth, because we do need to flatten the trajectory of debt to GDP. And taxes is a part of that. Now, I'll leave it to policymakers, but I will note the following. I've looked carefully, as you can imagine, given my background, on what the estimates are for certain proposals versus S&P 500 earnings estimates, okay? And a number of firms have made those estimates based on different rates, and I've watched that carefully. The adjustments look to me to be, they're not going to impede the growth. They might slow it somewhat. They look manageable. So I haven't seen anything yet in that those area of proposals that would cause me to want to temper or adjust my outlook for the economy this year and next year and in 23.
So you mentioned the U.S. being the reserve currency for the world. There's been a lot of conversation about China and cyber currencies. You know, supposedly, reportedly, it's now a $2 trillion market, and the Bitcoin alone market is $1 trillion. And, you know, Coinbase is being valued right now at like overnight at $100 billion valuation. The Janet Yellen said recently, I think, that it's something that the U.S. should look at is issuing its own cyber currency.
Yeah.
How do you feel that central banks around the world should be looking at cyber currencies, especially in the context of this issue of the U.S. dollar being the reserve currency?
So let's take this in pieces. First, I'll start with the last question. We should be studying it. And I think we publicly said we are studying it, and that's appropriate. We should be studying it. We may not need to be first, but we need to be actively working on it. Why? The whole payment system is going digital. While people are still using cash, you know better than most, we're migrating rapidly to a digital system. It makes a lot of sense that you would deeply explore a digital currency. Now, I would differentiate that from Bitcoin. Bitcoin has proven to be, wherever you are on it, a store of value, but it does so far flunk some of the tests for a widely exchanged currency because it's so volatile, and it's not been widely enough adopted. I don't know if it will be, okay? And also, there's some tracking elements to it in terms of identifying the participants that are also challenges, but as a store of value, maybe as a currency, I'm not as sure. So when you see China and other countries working on a digital currency, has to be stable value, something that it can monitor, regulate, and it's got to be widely adopted. And I do think you will see more. I think you'll see more innovation and adoption by countries of digital currencies. How that affects the dollars, the world's reserve currency, we'll have to see if it does. But I think that's another reason why the U.S. should be, and it's appropriate for us to be rigorously studying this subject.
Well, it's sort of also cyber sort of also bridges us into the whole fintech discussion too. It is sort of an interesting a phenomena, I'll call it, that PayPal today is really the second largest financial institution by market cap after JP Morgan. It's now over $300 billion of market cap. And when you look at Citibank and Wells, they're less than half. Goldman, your alma mater, is about 100 billion. So when you think about PayPal at 3 times the Goldman market cap, it's pretty remarkable. JP Morgan is approaching 500 billion, so it's still larger. But the number of fintech firms out there that are valued, say, above 30 billion are just extraordinary. And so, as you think about fintech and the regulation or lack of regulation, I mean, certainly, I think Jamie Dimon's comments the other day, he's obviously worried about the competition. But, I do think that there's a question about how the Fed ought to be looking at these companies and, and what's sort of the current thinking.
So here's the issue. And the Fed is not in a position to change what I'm about to say. We have very good visibility. We have jurisdiction, and we do tough capital requirements and stress testing on banks. That is our congressionally given mandate. We do not have jurisdiction or excellent visibility or the ability to stress test non-bank financials unless they become a bank. Okay. And this doesn't just extend to payments. I would go into lots of market activities, financial market activities, which are substantial. This is why you've seen the growth in the non-bank financial system dramatically outpace the growth of the banking system. And it's one thing if the Fed does not have good visibility or jurisdiction, but I do believe we need to have better visibility and jurisdiction and likely reporting, maybe stress testing, et cetera. And there is, some have said, there is an arbitrage going on where certain activities are moving out of the banking system because of this. And what I worry about in my job is not what I can see. I worry about what I can't see. And in the non-bank financial system, including fintech, when there's a problem and you're reading about it in the newspaper, it means you're late. And it also tells you that that's just what's being reported. What else is going on that you don't know about? And that could include excess risk-taking, leverage, other exotic techniques that you don't have good visibility on. And so I have said publicly, I am concerned about that and watching it the best I can. But the only way I can watch it is through discussion with market participants in these industries and hear them explain what they're seeing. I'd feel better if there was more rigorous visibility on these sectors.
That's very, very interesting. You have a remarkably challenging job, and your colleagues at the Fed have remarkable responsibility. Obviously, you're looking at what's happening in individual sectors of the economy, whether it's technology or real estate or what have you. How do you factor in the varying geographical areas, in the sense that, cities, it's no news to you, are weak right now and are projected to be weaker by many people in terms of upper income people leaving cities, in terms of just the cost of services and so forth. How do you factor all that in? And is the Fed, can you rifle shot any assistance to urban areas?
So I look at all that. So the trend pre-pandemic was cities were getting stronger, smaller towns and rural areas were getting weaker. And there was a migration out of smaller towns and rural areas. We're going to have to see how the pandemic might have slowed that down or rebalanced it, particularly with the ability of more people to work remotely. This is also where infrastructure will matter, okay? If there's high-speed rail, trains that go through a state like Texas is a good example, that might change the nature and the prospects for these smaller towns and rural areas. But this is a dynamic that shifted pre-pandemic, it's shifting during the pandemic, and we're watching it. Why does it matter? Getting back to our dual mandate, labor force. Where's labor? Labor is going to go to where the jobs are. And obviously, if you're in a town or city that's losing businesses, your young people are migrating to bigger cities, that creates dynamics. The unemployment rates, you should know, pre-pandemic in these smaller towns was very low. Worker shortages, including at fast food restaurants, were very severe. And so, yes, we certainly look at it. The other thing I look at by geographic area, mobility engagement. We actually track it here at the Dallas Fed by city and every state in the country. And you see differences. Right now, the main differences you see are due to the resurgence of the virus in some places, not in others. Michigan's a good example, Bobby. Probably, mobility engagement is deteriorated because of the virus. So we're watching that also. And just to understand, and the last comment I'd make is there's migration from certain states to other states. Texas is a good example of a state that is on the receiving end of substantial migration of people and firms. And while that's nice for Texas, and it makes me very optimistic about the state of Texas, it makes me also very aware that in a lot of these West Coast, East Coast, Illinois, others, higher tax states, how do you spend money on education, skill training, all the other things you need to do if your population growth is flat to down in a country that's population growth is slowing due to aging? So there's a war between the states, I used to say pre-pandemic, for people and for businesses. And if population growth is sluggish, that war tends to get intensified.
And that kind of gets into this whole, I'm always curious about the unemployment rate. I believe that the stated unemployment rate today is very close to what it was pre-pandemic, I believe.
Not yet, no.
Not yet. But
No.
in any event, people say that it's still understating the unemployment rate in terms of people that have left the job market. And so where do you?
Let me explain why. So I've always said, and I learned since I got in this job, again, I'm not a PhD economist, I'm a business person, but the first thing early on, I realized, so headline unemployment right now is in approximately 6%, plus or minus. Pre-pandemic was 3.5%. That's referred to in the lingo as U3. If you look at the Bureau of Labor Statistics, look at U3, that's U3. I've always looked much more at something called U6, which is unemployed plus discouraged workers, meaning I've given up. I talk about women leaving the workforce, discouraged workers, or people who are working, but they can't get enough hours. Probably the person that drives cars, is working, but their hours are a fraction of what they were. It adds all those threes. That figure is close to 11%. It's about 10.7% right now. It got as low as into the sixes pre-pandemic. Okay. And that tells on a 160 million person workforce, you've got a lot of slack that still needs to be worked through. I also will tell you, look by educational attainment, the unemployment rate, if you're college educated in this country, is very low. The unemployment rates tend to be more elevated, again, for high school and less. And then you look at these underrepresented groups, Black workers, Hispanic workers, and I pay a lot of attention to that because I want to look to where the slack is. A lot of the slack, and a lot of the job and hour loss that's in U6 is not for college educated. Some of it is, but a lot of it is for high school and less, and women with children. And that's, I want to bore in on that.
Yeah, Bobby, if I may, just one other comment, because that's very interesting. And I'm, obviously everyone should, I think everyone should, if they're not, be focused on opportunities for everyone in the country and inclusion of opportunities to participate in this great economic country that we have here. And there's a lot of discussion about how financial regulators may, be looking at how market participants are diversifying themselves or investing and so forth. Can you comment on that at all from the Fed's point of view?
Well, make sure I get the gist of your question. I will tell you, I look at underrepresented groups for one reason. If we can get them back in the workforce, we're going to grow faster. We talked about the government debt. Yes, we have to moderate our spending, but we got to grow faster. And that's workforce growth and improved productivity. And so getting these underrepresented groups in the workforce, for me, improving early childhood literacy, secondary education, skills training is not just a nice thing to do. It's a money thing. If you want to grow faster, have higher GDP, be able to better service our government debt, all of us make more money. It's in all of our interests. And I think in the past, for my taste, it's been talked about as a nice thing. If you want to grow faster, it's critical. And I think we should be talking about it in that. It's a business investment for the country, and it's a high return investment. It's one we should be making.
Well, especially with lower demographics in terms of growth, because you can't cut your way to prosperity. You got to have top line growth in Texas, which I give you credit because you're now been there for 5 years in that job. Okay. But Texas has so much growth. You talk about Michigan. Michigan has been for really 3 decades with flat growth. So, if you have inflation, for whatever reasons, expenses are going to go up. But if you don't have growth naturally, organically in population, you're going to have to take it from your competitor in the market in order to pay for your expenses. So Texas has this halo that is just an unbelievable growth right now. And it sort of has this momentum from all of its policies and how the government's acted there that has encouraged the state's growth. So, with hindsight, as you look at, what's happened in the last crisis as well as this crisis, what would you suggest? I mean, if you went back to Harvard and you were going to do a case study in the business school and all the rest of it, how would you approach looking and thinking about what you could have done better, what the Fed could have done better to really help the country?
So it'd be two things I'd bore in on. First thing I'd bore in on the differences, not the similarities, but the differences between the Great Recession and why it occurred and the pandemic. Because we talk about them like sometimes in circles, like they're the same, and they're not. One was the Great Recession. We went into it over leveraged at the household level, excess speculation, leveraging in the financial system, and we did not have stress testing for the banks. And so they became over leveraged, and we didn't have good visibility on the explosion of credit default swaps. And the reason it took us so many years to work our way out of it is it took years for the household sector to deleverage. And we had fiscal policy to deal with it, but a fraction of what we have now. And so that's part one. This is more of a natural disaster, external event. The household sector went into this in much better shape than the Great Recession. Fiscal policy during it has helped the household sector. I think the recovery is going to be much more rapid than the Great Recession, and the fiscal response has been multiples of the Great Recession. And so at the Fed, I need to be aware of those differences, because if I'm using a playbook from 2013 for 2021, I've got to be careful not to, I'll learn the lessons of 2009 and beyond, but realize this is different. Second thing is the leadership lessons, which I always learn. There's pre-crisis, crisis, and post-crisis. And in that regard, I've always said the leadership style of a leader, including a Fed official or government official, in a non-crisis needs to be one way. In a crisis, you've got to take action, you got to move faster, you got to expedite things, and you may have to be more directive and do some things that you wouldn't envision doing. But then you got to shift again as you move out of the crisis into, for lack of a better term, peacetime. You have to adjust your style again. And the actions that you took during the crisis that people are congratulating you on, if you don't pivot at the appropriate point, they're not going to be congratulating you for very much longer. And you might actually, you've got to make the pivot and the adjustment. Okay. And so I'm focused on that third phase right now. I think from a leadership point of view, in my old job at Harvard, all three phases are interesting, but making the transition from one phase to another, that's challenging. But first you have to recognize that you have to make the transition.
So, you mentioned in your old job, as you think we got about 5 minutes left. I just wanted to ask, as you think about, you've had the sort of three careers, maybe there's been 4 or 5, okay, but 3 major parts of your career at Goldman, at Harvard, and now here. And, what do you like best about all this? And, it's, as I've talked to you over the years, you seem to be really excited by what you're doing.
Yeah. So that's the one thing all 3 jobs had in common. I'm driven by passion and making an impact. And I probably wear my emotions on my sleeve a little bit more than normal people. And so I need to have a passion for what I'm doing. I did on Wall Street. And when I felt like I wanted to make an impact in the world in a different way, I went to Harvard, didn't expect to stay, but I realized I have a real passion for the transformation that you can make in students and in companies sitting at Harvard Business School, and as in the roles I played there. And then here, same thing. You can have a great impact on the country at the Fed. The challenge is the culture of each organization is very different. You got to adapt. My leadership style that would have worked at Goldman, I learned fast, will not work at Harvard Business School. And what worked at both those would absolutely not work at the Fed. I learned a number of things from both, and then I had to learn the Fed culture and adapt to this. I would say the Harvard culture was more helpful, and the experiences there were more helpful than the ones at Goldman for coming to the Fed, because you got to remember the Fed is led heavily by PhD economists, academics. And so I got a good feel on that ecosystem when I was at Harvard, and that was enormously helpful in me adapting to the environment here. But the most important thing to go with all three, you got to be open to learning. If you ever think you have the answers, you're in a lot of trouble. You better be humble, open to learning, and be willing to ask questions and play the student and take out your yellow pad and ask questions and take notes. As long as I stay like that, I've got a chance, but you gotta adapt.
So I guess you still have another 4 or 5 years there, right?
I do.
It's a 10-year deal.
It's series of 5-year terms. Yeah, I just started my second 5 years.
Well, congratulations. We're all thrilled you're there. Let me say that. I think that while the PhDs are very important and helpful, it's also helpful to have a business perspective, which you have. So, Jeffrey, did we have any other questions?
I think this has been, we have millions of more questions. I was going to invite you to make any closing comments that you might want to make. Maybe you covered those already, but if you'd like to.
Comment. So, looking ahead, I can't tell you the exact timing, but I'm optimistic. We will weather this pandemic. We'll at some point, and we'll move forward to making progress in this country. I think the job of the Fed is to be open to adapt, keep focused on our dual mandate, and be open to learning. I think it's still the most important challenge for me sitting here now, today, is be open to learning and avoid being rigid or predetermined in my views. Okay. And so, and I keep that in mind every single day. And I think people, if you could see what I see every day at the Fed and among my colleagues, the chair and all my colleagues around the table, I think you'd feel very reassured and impressed by the dedication and commitment to achieving our mandates. Even though the styles of each of us is different, I think we're committed to working for the country and making good decisions that create full employment and price stability.
Thank you very much, and thank you for your time. And I think that your visit with us has certainly reassured a lot of anyone who was watching today to know that the Dallas Fed is in great hands, sir. And thank you for your time and your comments. And perhaps we'll follow up on other things in the future. Thank you, Bobby, for joining us.
Great to be with you.
And bringing the real world into things. Thank you so much. And everyone out there, thank you for listening. If you're a Roundtable member, we hope to see you virtually April 20th. And then our annual meeting for everyone in June. Who knows? Maybe some of it will be in person, but I doubt it. It might be too early. But we certainly look forward to seeing you all in person again. And thank you again, Mr. Kaplan, for your time.
Thank you very much.
Rob, thank you very much. Thank you. I really appreciate it.